Hello friends, many times people ask me how to rebalance the portfolio. What are the best ways to rebalance the portfolio? Now it's quite very simple. A couple of things. Say for example, your portfolio is running for the last 3 years and you're looking at 23-25% annualized returns. Now the hunch is to keep on continuing like that. Now the basic logic is if your portfolio is already giving you 20 to 25% returns and the long-term average is 12 to 13%, then obviously it will fall down. There will be a period of 6 months or 8 months where you are not making any returns, and then you see, okay, now my returns are 11%. That is what has been happening over the last 6 or 8 months. So there are a couple of golden rules. Different people follow different rules. It depends upon how you feel comfortable with it. If you are quite a hands-on investor, then you can maybe go into simply direct debt and equity funds, no hybrids, no balanced funds. Then what you can do is, if you have an allocation of 50 is to 50 or 60 is to 30 or is to 10 or something like that, and after 1 year, if there is one asset class, say equity has given 20 or 30% returns, then you shift the extra money out of equity to debt or to some other asset class, let's say gold. Vice versa, if the gold has gone up, so whatever the extra money has been generated as an alpha in gold can be shifted likewise to other asset classes. This makes one thing very important, that is, over a period of 1 year, if there is one asset class that has overperformed others and generated alpha, so that means that it has become more premium, more pricey, more costly. So whatever the extra money or a return that has been generated, if you take that money out and put it into underperforming asset, then you are going into an asset which is underpriced in a value zone, and therefore you are able to have more units of those funds or stocks or assets, provided their fundamentals are not broken or the havoc has not act on that. So this is the way you can look at. Second way of rebalancing is based on your lifestyle or your life goals. Say for example, if you are nearing retirement and you already have a very good equity portfolio, then you will try to shift slowly and steadily into the debt. Or you have just touched retirement, then you will primarily go into the debt. So because you don't want to risk your money out there, because you need to make earnings or return on from your portfolio. So these are a couple of things you have to do. The smarter investor from their 40s or 45 itself, they will start building their long-term tax-free fixed income bucket, so that over the period in time, sequentially, they will be moving assets from their equity or stock holdings to their you can say fixed income asset classes, so that not only they reduce their tax liability but also bring balance in their portfolio. At another end of the spectrum, people can go with multi-cap funds or multi-asset funds that would have gold, commodities, and other assets altogether, which will take care of rebalancing of the portfolio. So these are a couple of the strategies which an investor can take while looking at the portfolio. But yes, it has to be backed by certain analytics. You should be knowing how and what is the standard deviation of your different funds, what is the cycle of inflation going on, what is the cycle of sector rotation that is going on, what is the sequence of risk that is going on, what is the concentration risk into the market, how the repo rate and macroeconomic policies are playing out, where the banking cycle or other trade or export cycle is there, so that you are properly placed in better asset classes to make return on your portfolio. And then based on that, you can take a call, and whether all these things and high and hoopla are in sync with your financial goals, expectations or not. Thank you so much. This is Rachata signing.